Hello, and welcome to our fourth quarter strategy review. Thanks again for tuning in. With me today on my right is Bob Toomey, Vice President, Director of Research, and on my left, Len Skina, Vice President of the firm. We met here on September 30th when there was a great deal of talk about the potential for a government shutdown and of course the even more serious issue of not voting an extension to the debt limit. These issues were definitely discussed in great detail, as well as our normal discussion about the markets, about all the different investments that we are making for you as our clients. The markets themselves look fairly decent at that time and frankly still continue. We just reached new highs on the stock market. We had also gone through the question of whether we were going to see the bond buying from the Fed slow down substantially, and it was decided that it would not be slowed down. So generally both the stock and bond markets looked quite reasonable. The question we had to deal with was what happens if we do get a government shutdown? What happens if we do not elect to increase the debt limit? And just to give a little perspective, I have a slide on the screen right now which actually looks at previous periods, 1995 through 6, 2010 and 11, and of course the current period of time. We did experience government shutdowns in the 95-96 period, not once but twice. The graph you're looking at is not the markets, but it's actually consumer sentiment. And you can see that consumer sentiment, once these were settled, revived quite rapidly. The 2010 and 11 period was even more dramatic. We saw big drops in sentiment and then rapid recoveries once the government had decided to end the debt ceiling battle. But here we are again. We've gone through areas where we've averted the debt ceiling. We've gone through areas where we have the actual shutdown of the government. And it's 9 days later, and the government, of course, is shut down. However, our feelings at the meeting, and frankly our feelings even today, are that this situation will resolve itself, and we frankly therefore took no overt action, nor do we think we should have taken any overt action at that time or this time. The feeling is that if we had a situation where the government was in fact shut down as it is, or even if we had the impasse over the increase in the debt ceiling, it would be unwise to actually make a move, because once you turn that sentiment back around, it would revive very, very quickly. So it's all done with that backdrop, and we are going to review why we made the decisions that we made at the meeting against that backdrop. To that end, I'd like to turn to Len and to start the discussion on the bond areas and what effects are being felt in the bond area.
Thank you, Stan. Interest rates have been going up recently, and one of the reasons that interest rates can go up is inflation, though we don't see inflation increasing right now, so that doesn't seem to be the reason. Another reason that interest rates tend to go up is with an improved economy. And our economy is improving, but the rate of improvement isn't that great. So we really don't see that contributing to a spike in interest rates anytime soon. The third reason that interest rates could be going up would be anticipation of a taper from the quantitative easing program that the Fed has been using to buy mortgage-backed securities. And while the Fed has been very, very transparent and clear about when they plan to end that program, nobody seems to be believing them. The markets and the media seem to be treating this all as any meeting that the Fed has could result in an interest rate increase. For now, we're taking the Fed at their word. We really believe that this is going to continue to go for a while, but interest rates have no place to go but up, and so we do anticipate that interest rates from here will continue to rise, which will result in lower bond prices. Because of that, we're continuing to use bond substitutes as we have for the last several quarters, and we will continue to do that to protect you going forward.
Thanks, Len, for those comments on the bond market. But can we just take a look at the unexpected and certainly probably the unthinkable of a bond default? What do you see that would be happening to the bond market at large if that happened?
Sure, Stan. In the past, when there has been some concern that the U.S. government could run into problems with raising its debt ceiling and default on some of its obligations, the stock markets have reacted negatively, but interestingly, there was a rush to bonds rather than away from bonds. And that was a flight to safety because people still regarded the U.S. government and the U.S. government bonds as the safest place for their money during a period of uncertainty. In the event that the unthinkable happens and the U.S. does not actually address the debt ceiling issue and does somehow start to default on these things, we would really anticipate that the bond area and the Treasury area would continue to be perceived, interestingly, as a secure area. It wouldn't really be a question that the U.S. government can't pay its obligations. It would be a question that you've got a bunch of idiots in Washington who just somehow can't act responsibly enough to do so. And so people would still have faith in the ability of the government to pay, and we don't really anticipate it being financial Armageddon.
Thanks, Len, for that very insightful comments on the bond market. The bond market, of course, is a very important area and one that is certainly affected by the areas that are being talked about in Congress. But as you can see, we are concentrating more on what type of investments we want to supply the income for our client portfolios. In that vein, I'd like to turn to Bob and ask him to cover the stock market from those same perspectives.
Thanks a lot, Stan. I'd be happy to spend some time talking a little bit about the outlook for the stock market. It's an area that most of you, I'm sure, follow yourselves at home. Despite the issues we're seeing going on in Washington, D.C. at this point relative to the debt ceiling and the government shutdown, the stock market is having a pretty good year. It's up about 15% year to date, including dividends, which is well above the long-term average of around 9 to 10%. We do remain positive on the outlook for stocks for a number of reasons. We see continued economic growth, albeit slow now. We do feel that there's potential for acceleration in growth next year. We expect inflation to continue to remain low for a number of reasons, and we do see acceleration in corporate earnings in 2014. We think all of those are favorable factors relative to the market. With respect to your investments, we continue to favor large cap stocks, and we continue to hold a balance of both growth and value in the portfolios. We, several quarters ago, added exposure to technology and healthcare. We continue to like those sectors and continue to hold those as important allocations in the portfolio. With respect to stock valuations, that's another reason why we believe stocks remain favorable relative to debt. The chart that I'm showing here shows a long-term valuations of stocks and bonds. If you look at the left side of that chart, it shows a valuation for bonds that is essentially the reciprocal of the 10-year Treasury, which is an equivalent of like a PE ratio on bonds. You can see that that valuation is very high relative to the last 4 decades and would indicate that bonds are not a very good value at this point. If you look at that right side of that table, you will see that valuations for stocks remain very reasonable relative to the averages over the last 4 decades. So we're trading about 14 to 15 times forward earnings is actually quite favorable relative to valuations that we've seen in the past. Is another important reason why we view stocks favorably at this point.
Thanks, Bob. Appreciate your comments. And of course, we are continuing to feel very strongly about the stock market. However, with the government shutdown and the impending vote potentially negative on raising the debt ceiling, What would have to happen to change our views relative to those two issues?
I think that if the government shutdown went on for, I'd say, more than several weeks or a month, I think it would start to get serious. The market so far seems to be taking this in fairly good stride. We haven't seen any dramatic plunge in the stock market. I think the market understands that this is part of DC politics that we have to live with. But I think that 1 month threshold is probably one that I would be focusing on. I think would raise more concern if we go beyond that.
Thanks again, Bob. I know that's a tough question. And maybe even a tougher question is, Len, let's talk about the international markets. How are they affected by our markets, and how are they doing after their big problems, recent problems?
Sure, Stan. Internationally, for the last few years, we've been seeing emerging markets outperforming the more developed markets. And that's a trend that over the last several months has reversed. The developed markets have started to get more healthy. They've started to outperform the emerging markets, and the emerging markets, frankly, got overvalued in a lot of ways. For that reason, we've pulled back from emerging markets. We did that over a quarter ago. We continue to not favor emerging markets right now. And while the valuations have certainly gotten more attractive than they were when we decided to pull out, we're not quite yet ready to pull the trigger and get back in. For now, we're continuing to stick with what we consider to be a more normal allocation with respect to international, which consists of primarily investing in the EAFE index, which is Europe, Australia, and the Far East. Europe, of course, has had its issues over the last several years, but while they certainly still have some financial issues and financial constraints going forward, their sky no longer appears to be falling. And over the last several months, Europe has very much outperformed the other markets with respect to their stock performance. So we're continuing at this point to invest in what we would consider to be a more normal international allocation. And we're going to continue to monitor the situation in the other areas of the world to see if it makes sense for us to invest there again at some point.
Thanks, Len. The international markets are certainly one that have come back into pretty much norm. And frankly, not stealing any thunder, I'd like to ask Bob to go over how we affected our overall model with these decisions.
Thanks, Stan. Happy to cover that. Well, in this last quarter's meeting, we decided to reduce our weighting in equities very slightly, by about 2%. And the reason for that is because we are anticipating a little more volatility going here into the fourth quarter. That has come to pass, so we did raise cash a little bit. We continue to shift allocations away from small cap and REITs. We raised our weighting in international to an overweight at this point. As Len mentioned earlier, we feel that outlook for international, particularly IFA and more developed international countries, is improving. We continued our overweight in the large cap sector. We believe there's a lot of value there, particularly in large cap dividend growth stocks, such as you are holding through the VIG. And within fixed income, we reduced our long-term duration, continued to do that as a result of our concerns over rising interest rates, and move some of that money into short and intermediate term fixed income vehicles.
Thanks, Bob. Once again, and thanks to you for tuning in. Today, as we shoot this, it's October 9th. We are 9 days into the government shutdown. The news is amazing to me that our congressional leaders continue in such total disarray and no one will make a decision. Hopefully, by the time you watch this video, we'll know what happened. But we view it, as you can see, as an event which will probably not change things much. It'll just continue to cause everybody to throw up their hands and wonder, how can we have such a terribly dysfunctional government and still continue forward? But we will. Thanks again for tuning in. Tune in next quarter.